Good afternoon. Thank you all for attending the TPO Go Introduction to Renovation Lending webinar. Some housekeeping things before we begin. We're going to take questions at the end. You can ask your questions in the Q&A box, and they're going to be monitored by Madison Tracy and Dawn Paulo, and they'll be asking the questions at the end. Also, there is a ton of helpful information in this presentation, so we'll be sending this out to everybody who has attended at the end. I am Philip DeFranzo, president of TPO Go. I started this business as a mortgage broker and was a mortgage broker for many, many, many years. My wish when I was a mortgage broker was that a company like TPO Go, and in particular, a renovation partner, would be the type of lender I would want to work with. And that's how we created TPO Go. I'm joined today by Trey Vandebogart, our head of sales. Our contact information is listed here. We would reach out to us at any time. That's our cell phones and our emails. We're available anytime. We always laugh that if we're up, we're working. So please, if you have any questions with regards to renovation, anytime. Simply put, TPO Go has the best, most knowledgeable, responsive AEs in the business. They don't just know products. They don't know just renovation products. They know all products. And if they have a question, if you have a question about renovation or any products, they're the people to call. The renovation team will hold your hand, which is kind of unique to the TPO Go experience. Our renovation team will hold your hand during the origination process. So as much or as little as you want. If you want us to handle the entire bid process with a builder and you just do the credit package, we'll do that. If you want to handle all of it and we'll back off on the renovation piece, we'll do that. So we will custom it and we're here to help you. A lot of people like it because if they're slightly intimidated by the builder portion of it, we will handle it from soup to nuts. TPO Go is a Fannie Mae direct seller servicer and a Freddie Mac direct seller servicer, and we're an active Ginnie issuer. We offer all different types of products. We do pre-approval, seasonal homes, conventional, reverse. We do mass housing, Connecticut housing and Florida housing bond programs. I love renovation, and I want to show you today that understanding and selling renovation will absolutely 100% guarantee increase your income. How renovation will increase your income is that there's an increase in national renovation spending. The housing inventory is aging rapidly, and we're going to allow you to, with the renovation loans, close more loans. The National Association of Realtors states average yearly national renovation spending has increased almost 60% from $15,000 in 2020 to $24,000 in 2023. According to the Global Market Insights, over close to $500 billion alone was spent on home renovations in the United States. Most homeowners are increasingly focusing on large projects, kitchens, bathrooms, roofing, windows. These large products is why they need renovation funds. 54% of all homeowners renovated their homes in 2024 in the US. This is why we're seeing a huge increase in renovations, not just for purchases, but also for refinances. How do people pay for renovation? As you can see on the left side, as renovation loan amounts increase, as renovation costs increase, so does the percentage of people who are using refinancing or home equity into their loan amounts. It's obvious, like the bigger the project, the more you need outside financing. Second reason why you're going to increase your volume is we have a rapidly aging housing inventory. There's not a lot of new construction. Housing stock continues to age. The median age of a home is 41 years. 50% of all the national housing stock was built before 1985. That's scary. 50% of all houses are over 40 years old. Also, we're going to allow you to close more loans. Like I said, I started as a mortgage broker. And when I began offering renovation loans, my originations grew by 30%. I didn't do 30% more renovation loans, but by having this tool in my tool belt, I was able to turn regular loans into renovation loans, but more also as important, I was able to turn renovation loans into regular loans. There's a loan officer in Connecticut who just focuses on the state and professes to be a renovation expert. What ends up happening is probably you'd think 100% of his volume is renovation. It's not. He gets about 30% of his volume is renovation. The reason being is somebody goes out and looks at a property and the property is in bad shape and they think they can do a renovation loan to it and they can't, or they think it's too big of a job or it costs too much or it doesn't work. What ends up happening is that renovation loan turns into a regular loan and they already have a loan officer that they're working with. So by marketing renovation loans or having that availability in your tool belt, so to speak, you're going to increase your volume by turning not only regular loans into renovation loans, but you're going to turn renovation loans into regular ones. Larger loan amounts. Our average loan renovation portion of our loan amount is just under $100,000. So you're going to increase your average loan size by $100,000 by doing renovation loans. And finally, two loans, not one. There's a huge refinance opportunity when work is complete. A large number of our loans, when the renovation portion is complete, have enough equity to refinance, and even in that portion, avoid mortgage insurance. So it's a double whammy. If rates go down and yet they can get rid of MI or they can go from an FHA to a conventional loan because of the equity they built in the property by doing the by doing the renovation, it's a huge win. And finally, you're going to save deals. Having the renovation loan program, you're going to save deals. We had a borrower who was an estate sale with a failed septic. The cost to repair the septic was $30,000, and the estate did not have the funds for the repair. Seller agreed to reduce the purchase price instead of losing the deal. Seller agreed to reduce the purchase price. The borrower changed his regular loan into a renovation loan, and we were able to pay for the septic repair. So the deal didn't fall through. We were able to save the deal with a renovation. Home appraisers below purchase price. Remember, an FHA 203K will allow borrowers to go up to 110% of the after improved value. Let me give you an example. We have a house that's listed, that house that's sold for $315,000 or was listed at $315,000. They do the appraisal comes in at $300,000. The buyer and the seller both want to do the transaction. The seller won't reduce the price. The buyer doesn't care. This is his dream house, still wants to buy it. What we did is we added $7,000 worth of appliances and some painting, and now we have the acquisition cost of $315,000 plus $7,000. Puts it at $322,000. But because he switched this from an FHA to an FHA 203K, he now can have the after improved value be at $330,000. So that $300,000 appraised value turned into $330,000, and he can use that with just 3.5% down. So it saved the deal by doing that. Another one is Fannie Mae Homestyle. We've seen so many of these right now. Fannie Mae Homestyle will allow you to do a refinance on a new construction, no previous CO, if it's 90% complete. It sounds crazy, but we've had one recently where the borrower had used his own funds during construction. It was 90% complete, ran out of money. No construction lender is going to touch him. We had another one where the construction lender was a bank and they got merged, and the new bank was not going to extend him past the 12 months. And he was 90% complete, so we're able to take him out with a Fannie Mae Homestyle. I would tell you, if you have anybody who's in that situation, look to this because it's a pretty impressive solution to getting somebody out of a construction loan. Another way to save a deal is mixed use. We had a borrower recently who found a three-family and was going to be an owner-occupied, had a small commercial space. Residents need a little work. The bank wanted 25% down because they considered it a commercial loan, and they would not do any renovation financing. We did it as a 203K with 96.5% of the loan to value plus and purchase price plus renovation costs. Key is that the borrower previously used to have to occupy the business as the residence and the business. Now you're just allowed to do it as a owner occupied. As long as you're going to owner occupy the residence, You can rent out the commercial residence somewhere else. Why renovation loans? Low down payment, one payment. You get to finance all your required health and safety repairs. If that's a new railing or, you need a deck repaired or a roof, you get to finance all renovations to upgrade your property into your dream home. It's very competitively priced. It's tax deductible versus financing on a high credit card. For example, $10,000 of repairs at a 6.5% interest rate is $63 a month. Home Depot right now, their credit card is 29.9% or $350 just in simple interest alone. So it's way better. There's just to back up to that, there's a lot of people that believe every loan in an older home should be a renovation because people get themselves into a pickle when they go out and they pay for things in using, high interest rate credit. It's a first lien position. We'll do owner occupied second homes or investors. Second home or investors have to be with Fannie or Freddie. 1 to 4 units, manufactured homes. Like I said, we do mixed use condos. We'll do co-ops. We've done some renovation co-ops and townhouses. Loan to value is based off of acquisition cost, which is also I consider it almost a purchase price, or an after improved appraised value, whichever is less. So your standard statement is sales price or appraised value, whichever is less. Acquisition cost is sales price. Acquisition cost is purchase price plus renovation costs. I'm buying the house for $200,000. I have $100,000 of a purchase price. $300,000 would be my acquisition costs. House appraised at $350,000 upon completion at the after improved value. I'm fine. I'm going to use the $300,000 as my loan to value. $200,000 purchase, $100,000 of renovation. The house appraises at $270,000. I'm going to use $270,000 because it's acquisition cost or appraised value, whichever's less. Reno funds are placed in an interest-bearing account. Funds are dispersed when the inspection work is complete. You have one monthly payment. You're not paying 5 different credit cards. You're paying one monthly payment. And you can even finance mortgage payments while the property is being completed during the time when the property is uninhabitable. The thing I love most about doing a renovation versus paying out of pocket, I even tell people, don't even self-fund it. Even if you have the money, don't do it. Cash flow is king. Here's an example. If I took a down payment, if I put down $250,000, $40,000 of renovation, and I paid that money out of pocket over 36 months versus paying it in my monthly payment, I'm saving from a cash flow perspective almost $750 a month. And I'm not waiting 3 years to complete the project or paying it out of pocket. I'm doing all of the work right up front. We do all renovation loans, all residential renovation loans, FHA 203K, FHA 203K Limited. We do the Fannie Mae Home Style, Freddie Mac Choice Renovation. We do VA Rehab, and we do USDA renovation. The beautiful part is when you work with the best AEs in the business, you can call them and say, I got the scenario, and they can advise you what is the best program for you to use. So the TPO Go difference, why did my business increase 30%? I think the most important part of my success as a broker was working with a lender that helped me from application until the renovation is complete. I know that people underestimate that, but we handle the disbursements internally. We help your person we help you and your borrower walk through the origination process. So if things are going to go wrong during, the borrower fires the builder, the materials don't get delivered. Things happen during the renovation process. They end up finding out that they have some rot and they need to use their contingency. Well, you don't want to call into an 800 line. You're a real estate broker, or you as a broker don't want to call into a real estate line, call into an 800 line. You want to call and talk to a person. And that's what you have here. You're going to be able to, and if there's some issue, you can pick up the phone and talk to your AE and they can speak to somebody. That's that is so important because renovation is not done when the loan closes. During renovation is done when the renovation is complete. And that's what people need to remember, that working with a lender that can, I mean, listen, things happen. The builder sends in the wrong form or gives us the, whatever. But at least you can speak to somebody. It's huge. TPO go difference on average to submittal to clear to close, from submitted to clear to close on all renovation products was just 32 days. Listen, I attribute that to our great upfront origination renovation team. They're not sitting around waiting for things. They're following up with the builder for all the documents they need. Drilling down the difference between regular and renovation, I think it really comes down to two things, pretty much two things, but primarily one is you need to get the builder and the work write-up completed before you can do the appraisal, because the appraisal is as completed. So I just say that because some people will be like, oh, I can do a renovation really quickly. You can do the credit portion of it, but you're beholden to whatever the builder can do from a bid perspective. It's because we can't order the appraisal until we find out what the builder is going to charge or what actually their bid is going to be. So like I said, our road to getting a renovation closed is obviously pre-qualify a borrower. You can submit the credit package. The borrower meets with a contractor and or HUD consultant. All products don't need a HUD consultant. Larger products, we strongly recommend one because they really will help the borrower and make sure the bid is correct. We do a review of the contractor to make sure that all the guidelines are met. We get the contractor documents. We order the appraisal after the bid is complete. We get your approval and then we get you to closing. Having people help you along the way is why our process is being done in like 30 something days. The borrower chooses a contractor. The contractor has to be insured both liability insurance and workers' comp. If you're a single contractor, you can waive off of workers' comp, but you do need to have liability insurance. You need to be state licensed. We need a detailed bid for the appraiser to do their review. They need a detailed bid between labor and materials. Note, government loans, the 203K and the USDA, you can't have a relationship between the borrower and the contractor. A GC is required and a general contractor is required for a standard 203K renovation loan. I'm also including a example of our contractor acceptance package. This is a hyperlink with this. These contractor acceptance package, if you want to fill them out, if you want to meet with the contractor and do them yourself and not have our team do it, they're a fillable PDF. So it's really easy. And there's some, questions about like how much they're going to spend, what your experience is, what your liability insurance. So it's pretty standard, pretty easy, and it's all fillable PDF. I love the idea of working with a HUD consultant. HUD consultant protects the borrower and will make sure that the bid is appropriate. A lot of people hate working with a consultant because they feel like it might be add to the cost of it. But I can tell you honestly, if you have a big enough bid, even if it's a conventional loan, my recommendation is to either work with some type of an outside consultant, a HUD consultant. The consultant will do the draw inspections, submits paperwork to the lender to get the money. We'll do that on 203Ks and USDA loans. As part of it, we have a hyperlink to show you what HUD consultants are available in your website. And yes, HUD consultants can be used for non-203K loans. HUD consultants have specific fees that are dictated by HUD. These are them. You cannot charge more than this. If it's a $76,000 renovation portion, they can only charge you $900 for the work write-up. They can charge mileage and they can charge you an inspection. So it's a little bit, I would say, slightly pricier than what you would do with a standard appraiser going out and doing an inspection. But quite honestly, it's well worth it because they really are protecting you as the borrower. We do one appraisal. The appraiser will use the contractor bid. A key thing is that we've seen a lot of ones recently where utilities are shut off. We can get, you can do it without, as part of the renovation, you can, like we have at a foreclosure recently, it was the utilities were shut off and they had to flip it to a renovation loan so they could actually close it because the bank wouldn't turn the utilities on prior to closing. So there's definitely options that you can use, but the appraisal is upon completion, the value is upon completion, and it's based off of what the bid is. Now I'm going to turn it over to Trey, who's going to do a little bit of a deeper dive. And yes, that is Trey in his little.
Thank you, Phil. That was great background on the renovation products. Now I'm going to dig a little bit into each specific product, how they can be used, what's allowable, what's not allowable. So I'm going to start off with 203K. 203K is definitely the most popular renovation product, both the limited and the standard. There's a couple differences between limited and standard. The big one is that 75,000 in total reno cost for a limited 203K. That 75,000 again is including all contingency reserves, finance renovation fees. So that's total renovation, not just the cost of labor and materials. Typically, that's around 67,000 in total in renovation costs will fit under that 75,000 total reno. The other difference is no structural repairs are allowed. So anything structural will make it a standard. There's two draws per contractor or per limited. So one's at closing, and then the rest is upon completion of all the work. And that final inspection for that final draw will be done by the original appraiser or HUD consultant. You can have a HUD consultant on a limited, it's not required. Here's just an example of what a limited 203K will look like. Again, $30,000 of repair costs, the contingency inspection, title update, and supplemental origination all goes into that total renovation cost. You get an after improved value of 235,000 and an acquisition cost of 234. We're basing it off that total that acquisition cost for that down payment of 8192. Now on to standard. There's no maximum renovation cost for standard 203K. You're up to your county FHA limits there. There is a minimum of 5,000 in repairs. Again, you can do structural repairs, you can do conversions, additions, you can add ADUs. The upfront money on a standard is limited at half of the material costs up to 20,000. So keep in mind, contractors can get money up front, but it is capped at 20,000. A big benefit to the standard 203K is you can finance up to 6 months of mortgage payments if the property is uninhabitable. Keep in mind it is financing those payments, so you do need an appraised value that allows for 6 months to be financed into that loan amount. 203K eligible properties, 1 to 4 units, condos, that's walls in on condos, so it's interior only, manufactured homes, mixed use, and then existing properties completed for over 1 year or moved to a new foundation. Necessary improvements following FHA are required on 203K. A great benefit here, like Phil mentioned, is if you have a property that's failing on an appraisal report for health and safety repairs, you can flip it into a 203K and add those repairs. Or if you're already doing a 203K, you can just add that to the bid amount. But they are required to be repaired to FHA guidelines. Ineligible 203K improvements, the addition of luxury items are not allowable. So, for example, in-ground pools, saunas, tennis courts, your borrower can't renovate those into the property using a 203K. However, if there is an in-ground pool already on the property, they can repair it using a 203K. So they can't add one, but they can repair it if it's already on the property. Here's another example of a breakdown of a standard. As you can see here, your total acquisition cost is 465,900, and your after improved value is 450,000. This is a great example of that 110% value cushion that FHA allows with the 203K. So as you can see, just diving in a little bit more, the breakdown of how this is actually calculated. It's the lesser of 110% of the after improved appraised value, or the purchase price plus the renovation cost. So as you can see, total acquisition is 465,900, and then 110% of that appraised value would get you to 495,000. So we'd use the lesser of the two at the 465,900. And that's what you're calculating your LTV off of. So just keep in mind there that value cushion is there. If a house does appraise a little bit less than you expected, 203K is a great option to either flip into a 203K and save an FHA deal so your borrower doesn't have to pay the difference, or just give you a little cushion on those renovation loans. Now, onto the conventional side. Um, Home style and choice are pretty similar. There's a couple of slight differences, which I'm going to call out here. But again, it's up to conventional lending limits. It's 95% LTV on 2 to 4 family owner occupied homes. You can also do 1 unit second homes and investment properties. Big difference from conventional to FHA is that luxury items are permitted. So those saunas, tennis courts, in-ground swimming pools can be added to the property using a home style or a choice renovation. A big difference on home style is up to 10% of a contractor deposit can be dispersed at closing. Home style is the only renovation loan that offers that contractor deposit to be sent at closing. Repairs are capped at 75% of the after improved value. So slightly different to 203K where there's no maximum repair amount. Up to 75% of the after improved value can be in renovation. Quick example, $1 million appraised value, you can repair up to $750,000 in that renovation fund. On the choice renovation side, very similar to Fannie Mae, just a couple of differences. On Freddie, we will allow for co-ops. That does follow condo renovation guide, so it's walls in, but we do allow for co-ops. The other difference here is that you can qualify using rental income from an ADU on choice. So both of them allow you to add an ADU to the property, but only choice will allow your borrower to use that rental income from that ADU that they're renovating into the property to qualify. VA. So you have all the benefits of the VA home loan, and you can add renovation to it. So again, it's 100% financing. There is up to $100,000 in renovation funds. So there is a cap there on the renovation amount at $100,000. Again, VA, we know there's no maximum loan amount, and up to $15,000 may be available at closing for materials on VA. Eligible properties for VA, 1 to 4 unit owner occupied. Condos, they must be VA approved. You can do townhomes, PUDs, manufactured homes. Just keep in mind on manufactured homes, renovations cannot be structural or add additions. Same with USDA. So again, another 100% financing option for renovation loans. There's both a standard and limited option for USDA. It follows the same as FHA. So 75,000 maximum repair cost for a limited. Standard is going to include anything structural. Again, no luxury items, no manufactured homes. You can do additions. You can add ADUs. You can add new appliances, which is a benefit to all of the renovation products is that you can add brand new appliances to the property. You can go to this link to find USDA eligible areas. A lot of the times we offer down payment assistance, and a lot of times I'll hear about a down payment assistance program in a certain area. I'll look it up as a USDA eligible area. So maybe they don't qualify for the down payment assistance for one reason or another, but they can flip it into a USDA and still take advantage of 100% financing. ADUs. ADUs are a huge part of renovation. As we know, they're becoming increasingly more popular due to adding more space to the home, even adding some potential rental income to the home. Our renovation products allow for both building and repairing ADUs. So with the 203K, you can add an attached ADU or repair an existing attached or detached ADU. So just a note there, if you are looking to add a detached ADU, 203K isn't going to be your option, but you can add an attached ADU there. Fannie and Freddie allow for both attached and detached to be added to the property. Again, Freddie allows you to use rental income. So if you need the rental income to qualify, you do have to go Freddie there. And then USDA allows you to add or repair an ADU as well. After closing, like Phil mentioned, the renovation loan isn't closed at closing. It's closed when renovation is completed. We handle all draws internally, which is a huge benefit. So work begins right after closing. Usually there's 5 draws. That's getting paid out as work is completed. Typically, it coincides with the work items that are on that bid. If there's 5 work items, 5 draws, that makes it easy. If there's 3 work items, typically we'll see 3 draws. And typically that's decided between the consultant and the contractor prior to closing, so the contractor knows what to accept. Um, Draws are requested by the borrower and the contractor, and everyone involved should sign that draw request. As we all know, or as most of us probably know, contractors are looking for funds upfront. So upfront money does vary by program, but at least 50% of the material cost up to 20,000 is available on all. So just depending on the different product, our renovation team is going to be able to better advise you on specific products that you have in process of what upfront funds look like for that contractor. Changes. I'm sure if anyone's done renovations to their property, they know once those renovations start, there's always something that's going to change, which is perfectly fine with the renovation loans. Just all changes need to be approved prior to that changed work being completed. Same thing, the borrower has that contingency reserve. It is there for them to use if they want to use it. That just has to be requested to us prior to that work being completed, and then they can use that contingency fund to add work to the property. All checks will be payable to the borrower and the contractor when work is completed. That's there to protect the borrower. We want to make sure both the borrower and the contractor agree that that work's been completed prior to the contractor getting those funds. We do allow for ACH payments directly to the contractor, but that ACH approval form has to be signed by the borrower as well. There is a 10% holdback on all draws until all work is completed. Again, there to protect the borrower. We've seen contractors who walk out on jobs. We want to make sure that borrower has enough funds in their escrow to be able to complete the work. If that contingency fund isn't used when all work is completed, it's taken and it's applied directly to principal. So unfortunately, they can't get a check back, but they can apply it directly to principal. Some great ideas to increase sales using renovation. Ask your referral partners, ask your real estate agents for stale listings, TLC listings, fixer-uppers, anything that needs repairs. And we can offer a free feasibility study to help market their listing. That feasibility study will give them a list of repairs that they would advise for that property. And that realtor can go out there and market that product or market that property with a plan of how to get it up into move-in shape. I would also reach out to local home improvement contractors. There's plenty of contractors out there who probably have bid on jobs. That bid came in a little bit higher than the homeowner expected. They're not able to pay for that at this time. That's a perfect opportunity to refer that over to you to offer a renovation loan for the contractor to be able to complete that work. So that's definitely a great referral source is your home improvement contractors. Um, Search for foreclosed properties. I'm sure we've all seen foreclosed properties that aren't in the best shape, but that's a great opportunity to market it as a renovation loan. Maybe it's not move-in ready, but if you sell the idea of where the property is located, what work can be completed, and offer a solution with a 203K or a home style to be able to make that happen, that's a great opportunity to bring in an extra loan. And HUD consultants. Reach out to HUD consultants. They might need a lender for referrals. HUD consultants, it's all they do is be a HUD consultant. So every opportunity they have to partner with a lender who's selling renovation, they're always looking for new lender partners and new loan officers who are selling the product. And we're going to send this out to everybody. Here's just a link to all of our guidelines. It's great information here. These are all very recently updated, so 100% accurate. Reach out to your AE as well. They'll have access to all these guidelines. They can send them over and they can talk a little bit more in detail about each product on specific scenarios. Again, here's the link. If you're not already, become a partner. Like Phil mentioned, we have the best AEs in the business. So whatever market you're in, you're going to be treated with some of the best AEs. And then any questions?
All right, guys. So just want to make sure you all can hear me.
Yep, we can, Doug.
All right, perfect. So we do have a couple questions that came in. Excuse me. First, can you get new appliances for all the programs or just USDA?
I'll take that one. Yeah, you can do it for all. You get new appliances. The only difference is that if you did a limited 203K versus a full 203K, you have to have a minimum of $5,000, but all of them can have new appliances, paint, you know, flooring. Like I said, a lot of times people will use it to try to get that 110% value, and they'll paint the inside, change the flooring, and get new appliances. So yes, you can.
All right, awesome. Does the payment re-amortize if the contingency is applied to principal at the end of the loan?
The payment that you can't, if it's a, you can recap uh, a conventional loan, but you have to request that, and there's a charge to do that. You cannot with FHA. It just goes towards principal. And then as your payment goes, you're going to actually pay more towards principal. So yes.
All right, awesome. On an FHA, when do you need a
Can I just
second?
say one? I just want to say
Oh,
one thing about contingencies.
sure.
Some people use their own contingency funds because they don't want to finance it. So we require contingency just in case. If you use your own contingency funds, which is an important part, you can refund that back. It doesn't have to be paid down towards principal.
All right, awesome. All right, on an FHA, when do you need a second appraisal?
Trey, you want to take that?
Yes. A second appraisal is only ever required on FHA for a refinance. And there's only two circumstances you'll need a second appraisal. One is if you're using max financing, so 97.75 on a no cash out refi, or if that property was purchased within the last 12 months. Those are the only two times you need a second appraisal on FHA.
All right, awesome. Thank you. We do have some more coming in, so bear with me here, guys, but these are all great questions, so keep them coming. Is it true that if the house does not appraise, then the loan cannot be done?
No. I mean, if it doesn't appraise to value, I mean, if you can always reduce it, reduce the loan amount. We've seen people rework the bids to they put some things in there that might have not added necessarily to value. So it's definitely an ongoing conversation. So it's not automatically like it doesn't appraise if the deal's dead. We've seen our team rework them a lot. And once again, a real reason why you should work with a group that has a separate renovation group, because they spend a lot of time reworking those.
All right, awesome. Do I need a consultant on a Fannie loan?
You don't need a consultant. There are certain circumstances where our underwriters will recommend or require a consultant just based on that scope of work. For example, we have a home style actually in process right now with $650,000 in renovations. We want a consultant to look at that, one, to protect the borrower, and two, just to improve that post-closing process. Consultants, all they do is look at bids all day long and work on draws. So they're just a little bit more equipped to make sure that bid's actually accurate for that borrower, rather than say just the borrower and the appraiser going out for those post-closing draws.
Perfect. We have another one. I seem to find that the FHA Max Mortgage worksheet can be a little confusing. Would someone help me with an MMW?
Yeah, absolutely. All of our AEs are really good at it, but also our renovation team can do it. It's one of those things like once you do it once, there's an Excel spreadsheet you can do, but once you do it once, you're not required to do it as the part of the process. Some people like to do it because it helps make more sense as far as what they're going to do for a max renovation amount. Once you do it once, it makes sense. It's just the first time the way that the form's laid out, it's confusing. So absolutely, yeah, hit us up and we'll even walk you through it or do it for you. So
All right, great. Let's see. Do we send a property over if we have a client looking at it, and would you guide us on which program it may qualify for?
Go ahead, Trey. I would say absolutely. We're constantly doing that. Sometimes it's also credit worthiness too. Like you may have a borrower who can't qualify for conventional loan, needs to go FHA, or you may have a borrower who needs the 110% of value for an FHA. So having all of the tools, all the renovation tools in our arsenal, absolutely. You just don't want to go with somebody who just does FHA. You want to have somebody who can say, well, wait a minute, the guy's a veteran. He's only doing 50,000. It makes more sense to do 100% financing with no MI on a VA loan. So absolutely.
All right, awesome. How long does the borrower have to occupy the property?
Depends on product, but it follows standard FHA or Fannie guidelines for primary residence. So renovation doesn't change those primary residence guidelines.
All right, great. And you guys keep pushing those questions in. I love it. All right, on a limited 203K, the borrower can pick and choose, say, the plumber, the painter, the carpenter, etc.
Yes, the only thing with that is you have to have a separate contractor agreement with each person and bids from each person. So yes, a lot of people will do it where they'll have a general contractor just for the ease of it, but absolutely you can have separate contractors for each part of the process.
All right, awesome. Can I do a two-family investment on a reno?
No, Fannie and Freddie both cap it at one unit, second homes and investment properties.
And I think the LTV is at a max at 75.
All right, awesome. Do you have any marketing materials we can use to promote renovation loans?
Yes, we can get those out to you. Definitely. We'll include those in our package that we send out.
Great. And this question has come over a couple times. Yes, we are going to be emailing the presentation deck over to you
Yeah.
guys. So just so
Yeah.
everyone is aware. Um, all right, another one coming in. I know the total construction cost cannot exceed 75% of the after improved value with Fannie or Freddie. But can you confirm the total loan amount can go up to 95% of the after improved value?
Yes. Yep. It can go up to 95%, the total loan amount. So the purchase price or payoff plus the renovation amount um, can go up to 95%.
All right, awesome.
And I think I might is Trey, is the investment on a single family 85 or is it 75?
I believe it's 75.
I thought it's eight. Well, we'll have to double check that, but I think it might be 85. But anyway,
All right. Speaking of an investment property, we have a broker that is kind of surprised you can actually do a rental loan on an investment property. So the question is, does the investment property have to be a single unit?
yes. Yeah, they won't do multifamilies in any way. It has to be single unit.
All right, awesome. Will your team interact directly with the builder?
That's probably yes, and that's probably one of our best parts of it. Um, they will absolutely work with you. They will work with the broker. Like I said, they'll do the max mortgage worksheet and go over fees. They'll work with you as a broker to give you that information. But also, we have a person who, if you would we have some experienced brokers who have done a lot more renovation than me that want to handle it with the builder themselves. They can do that. But if you would want us to take it over, we'll deal directly with the broker and get the documents. I think that's really been an indication of why our turn times are so great, because we're not waiting on, we understand what it is to, the follow up to a builder. So yeah, no, absolutely. We will definitely reach out directly to the builder.
All right, awesome. Is a feasibility study expensive?
No, no. So we only require a feasibility study on conventional loans if that scope of work is complex and we don't deem it necessary for a HUD consultant. We'll require a feasibility study, just a second set of eyes on that bid to make sure everything makes sense. Prior to having a loan in process, we do have a link to a free feasibility study that can be done on a property. What that does is it gives the realtors just a little bit of an idea of what work needs to be completed or should be completed to that property so they can go out there and market it. So kind
And
of
I would 100%. I had a great success when I was a retail originator using that as a marketing tool. Definitely, like Trey said, go out and look at the TLC needs repair listings, and a lot of times it's like helping a realtor market a listing. You're going to turn into a superstar. So I had great success with that, especially as, it's not an in-depth feasibility study, but at least it's something they can use for our marketing.
Sure. What delays a 203K?
I would say the biggest delays are contractors.
Yeah.
And not in a negative way on contractors, but I'm sure anyone who's worked with contractors knows they're not the best at paperwork and they're not the best at using technology. I say that my dad's a contractor, so I know he doesn't even know how to use a computer. So being able to get the contractors on board is definitely step number one up front. If you know it's going to be a renovation loan, explain to the contractor that they're going to have to complete this packet. The quicker they complete the packet, the quicker we can get that loan to closing and they can start work. And then the other piece on that with contractors is making sure they're aware, they know it's a renovation loan. Throughout the process, our team explains to them what that means and when they will get paid for that scope of work. But knowing upfront that they're not going to get paid until work is completed is a big key to making sure contractors are on board and it's a smooth process.
All right, awesome. How are EPOs handled? This broker recently closed a home style reno. When the work is done, less than 6 months, borrower wants to refi to a VA. Do I have to wait for 6 payments before they can refi before triggering an EPO?
Oh, I don't know the answer to that one. I'll have to get back to them on that. I believe so. I believe you have to wait 6 payments, but we can check that if you have. Yeah.
Awesome. We do have another question about the max LTV for an investment property.
I confirm 85.
It is 85.
Both Fannie and Freddie's 85.
Yeah.
All right, great. If a property had a house fire, but it had been mitigated, would the fire be an issue for any of the renovation loans? Are there any limitations on what can or cannot be done for repairs, or if further mitigation is needed with a renovation loan?
We just don't want it to have another fire. I'm just kidding. No. We have done fire damage properties, so no, there's not any special issue with a fire damage property. No.
Awesome. How many appraisals are typically done on a conventional renovation loan?
Just one.
As completed, a completed value, based off of the bid and the purchase price, what's going to be done. The difference is on a conventional loan and a VA loan, it has to be 100% value. You don't have that 110% cushion. So if you're buying for 200,000 and doing 100,000, your property would only have to appraise at 270 if you're doing an FHA loan. If you're buying for 200 with $100,000 of renovation at a conventional at Fannie, Freddie, VA, USDA, it has to appraise at 300,000 upon completion. Just makes it a little bit tighter, but yeah, 100%. Only one appraisal.
Great. When a buyer is house hunting, do they need the contractor workup prior to making an offer to purchase so they know the deal will fly?
No, I mean, like Trey said, we've used the feasibility study as a tool, the free one, just to get an idea. A lot of times, the problem is that if you're not somebody like Trey, whose dad's in the contracting business, a lot of times people think like, oh, that's $10,000 and it's 30. So we always say, it's always good to have a second look just to see what they think it's truly going to be before they, go to the, apply for a loan or something. But no, you don't have to have the full write-up before.
All right, awesome. Speaking of a feasibility study, what would you need from a realtor to be able to complete the feasibility study?
I think just the listing, Trey, is that correct? It's just the listing.
Yeah, just the listing.
Awesome. What can I use my contingency for?
That's a good question. Contingency, the contingency could vary. Ours is a minimum of 10%. If the project gets larger, they could ask for a larger contingency. Contingency is basically in place for work overruns or you change. If you do anything during the course of renovation, if you change something, you're going to have to show us what you changed. But if it's simple, like I went with the bigger chandelier and now it's instead of 1,000, it's 2,000. I want to use my contingency. That's really what it's used for. Some people like balk at a contingency. That's the smartest thing you can do in a renovation. I don't know if anybody's done any renovation or any new construction, but like you always are going to end up with cost overruns in some way, either through cosmetically, like, oh no, I don't like that doorknob, I want this one. Or also like you open a renovation, you open a wall and suddenly there's, a damage behind it. I strongly recommend, we require a minimum of 10% 50%. But if you think it's a big job or you don't know what's going on, do a bigger contingency because at the end of the day, it just goes down towards your principal if you don't use it.
Okay, awesome. Does the timeline apply to occupy even if it's due to health and safety?
No, because you can finance up to 6 months of your mortgage payment. You can finance those. So they understand that if you can't occupy the property, they're not going to require that to be done. So no, like they're giving it's like a special exception to it, understanding that it's like it's unoccupiable.
All right, great. On a mixed use for a 203K, are there any types of commercial that would not qualify?
No, I don't believe so.
No.
But the commercial is a certain percentage of what the commercial can be. So you can't have 80% commercial in a little apartment. It's got to be, I think the commercial can't go over 49% of the total building square footage. And the residential units can't be more than 4 units. Also, and in the renovation you can only repair health and safety issues in the commercial space. They won't allow you to do any other improvements to the commercial space. It's only for the residents.
All right, perfect. What's the limit of number of properties an investor can own as well as financed properties with a rental loan?
I don't think there's a limit with Fannie for the number of units. It's just they can only do 1 unit, but the same credit requirements would apply.
Okay. Excuse me. What would delay a USDA reno?
I think to speak to what Trey was saying, I think the most delays that we have is just working with the builder to try to get their information. So I don't think USDA for us takes any more time or any less time. Um, Obviously, the benefit of the USDA is 100% financing, just like with a VA loan. So we haven't really, but once again, it has to appraise at value. So
All right, great. Can TPO Go help with appraisal ordering to make sure we get an accurate after improved value?
Yes. Yeah. We actually, our renovation department reviews all appraisal orders on renovation loans prior to getting sent over to the AMC, just to make sure we have an accurate bid in there. Um, Typically, if you don't have an accurate bid or if you make changes to the bid post the appraisal being ordered, that's a change request through the AMC. So making sure we wait to order that appraisal till we have that finalized bid is a key to getting those appraisal back both accurate and on time.
Yep, and I think too, our reno team would actually prefer that they order the appraisal for you guys. So,
yeah.
um, can a loan be submitted as a TBD for any reno option?
Yes. However, I typically say just submit it as a TBD, not renovation. So just an FHA TBD. Reason being, if the borrower is approved for a $400,000 purchase, it doesn't change that they're going to go to renovation because they could buy a $250,000 property and do $100,000 worth of work and still be pre-approved for a $400,000 purchase. So it doesn't really matter that it's renovation because you don't know what work's going to be completed to the property. That doesn't really change much on that pre-approval. You're just looking more at the total loan amount that they're pre-approved for.
All right, great. And we have a little bit of clarification on a question that was asked previously. So I'm going to repeat the question and just give you guys a little bit more info. So the question was, they know the total construction cost cannot exceed 75% of the after improved value with Fannie or Freddie, but can you confirm the total loan amount can go up to 95% of the after improved value on a refi, not a purchase?
Yes. Yes, 95% of the lesser, 95% max LTV on Fannie or Freddie. The 75% is just for the total renovation cost.
Keep in mind when you're doing a renovation refinance, you can't take any cash out. So just to be clear on that, it's not like, oh, I'm going to take some additional cash out to pay off debt because you can't do that. So just when you're working your figures, just you can go up to 95 LTV, but there's all renovation refinances are no cash out.
All right, great. And we're bringing it back to that feasibility study. So, will the feasibility study suggest necessary repairs, costs, estimates, and best programs to use for the particular listing, or will it suggest both necessary and other available repairs?
You can do two levels of feasibility study. The free one that we have is pretty limited to going off of a listing and kind of making an idea of like what this work is what they would recommend the work to be done. On a larger project, we had one recently in the town next to us that was a pretty bad shape bank-owned property, and the bank reached out to us. We actually sent out the HUD consultant, which did cost us some money, but it did help market the property because the HUD consultant did more of an itemized write-up. So you can do it two ways if you want it to be really in depth, if it's something that needs some real help. I'll tell you one thing though, like I keep saying this, but feasibility studies and talking with a realtor about a property that needs repair was a game changer for me as a loan officer because you're going in to help somebody do something. Now, the joke of it is that most of the properties that I did feasibility studies didn't sell renovation loans. It did in turn, maybe a small percentage of them, but it did show the realtor that you're helping. And a lot of times it helped market that property. So I strongly recommend it. But it was just, yeah, I mean, you can do it two different levels and we can explain that if after the call, you want to give us a call, we can run through both options.
All right, awesome. We have 1 minute left and two questions remaining. So, does the LO and realtor get paid when the loan closes or when work is complete?
They get paid at closing. So the
Yeah.
benefit there is they're paid at closing. And then we're working with the contractor post-closing to get them paid when work's completed.
All right, I don't want to say I'm a liar, but another question popped in. So we now have two questions left.
That's great.
On a 3 to 4 unit FHA, I assume the self-sufficiency test is still needed to pass.
Yes.
If so, and it's a qualifying 3 to 4 unit mixed use, can the rental income from the commercial piece be used to pass that test?
No, rental income from the commercial space can't be used to qualify and can't be used to pass self-sustainability.
All right, awesome. Last one. How does the free feasibility study know what suggested repairs need to be made based solely on the listing remarks if the MLS of the repairs required are not detailed?
Once again, the free feasibility study is not an in-depth. It's kind of basically, the person will talk to the real estate agent and it's pretty on top. It's not like a deep dive, but like I said, if you have something that you really need to do a deep dive, a lot for a few $100s, a HUD consultant will go out and do a look because they'll subtract that from whatever their upfront fee is when a thing goes to a full write-up. So, if you have I would recommend you go into your area, look at a HUD consultant, talk to them, say like, I have this property. What would you cost to do a feasibility study, even if it's not free? But if you have a small one that needs a roof repair, or like a couple of small items, then the free one might be a better bet. But I've done it both ways.
All right, great. Well, that is all the questions I have
That's
for
great.
you guys today. Thanks.
If anybody has any other questions or any other, please, like Trey, me, all the account executives are always available for questions. We pick up the phone, so definitely reach out anytime. And thank you very much for attending. This is great.